give you a brief overview of what we do here at Market News International. Then Vicki Schmelzer will speak for about 15 minutes discussing the outlook for currencies and select commodities for the final quarter of 2011. And follow with a question and answer session. If you have any questions at any point during the presentation, you can address it to Vicki directly by the chat function on the right-hand side of your screen. And you can address it to myself as well. We'll try to get to all of your questions, time permitting. And you can email Vicki with your questions after the webinar, or email me for a playback recording of the slides used in today's presentation. We'll have contact information available at the end of this webinar. So a little bit about M&I. We are a subsidiary of the Deutsche Börse Group and the leading provider of news and analysis, specifically for the global foreign exchange and fixed income markets. We're one for real-time English language financial news agencies with credentials recognized by governments and central banks of all major economies. We offer exclusive monetary and fiscal policy reports, economic indicators and forecasts, and market-moving interviews with key central bank and finance ministry officials, government policymakers, and economists. Our lists are located throughout 12 news bureaus across Europe, America, and Asia. We have 60 full-time reporters, many of which are former fixed income and currency traders and strategists. And featured reporter is Vicki Schmelzer. Vicki is our senior foreign exchange reporter and is the creator and author of the FX Spot, a daily currency feature for M&I's main wire product. She also writes other analysis pieces during the week dealing with currency and commodity trends globally. They traded spot and forward currencies for over 20 years at major U.S. and international banks before joining M&I in 2000. She has appeared on Forex TV and is currently working on a foreign exchange book with Barbara Rockefeller of Rockefeller Treasury Services to be published in 2012. And with that, I will turn our presentation over to Vicki.
Hi, everyone. I wanted to wait until after yesterday's Fed decision and last week's ECOFIN meeting in Poland so we'd have a better idea of what the underlying fundamentals will be going forward in both the U.S. and the Eurozone. To formulate a view about currencies and commodities, we have to have at least some knowns. And currently, this is a world of great unknowns instead. If you have problems trying to understand the various tailwinds hitting the global economy, have pity on the global central bankers. I attended a Euromoney conference Wednesday with RBA Deputy Governor Rick Battolino, who said, hard to know how long the turmoil will last and if it will continue. At least we have the Fed decision under our belt. The market has reacted quite negatively to the Operation Twist, but we need to look at this in line with market expectations. Most traders and analysts I spoke with this week expected the Fed to do the twist. At the same time, they acknowledged that this would not do much to help the U.S. economy. After the meeting, it was clear that there were some in the market that wanted the Fed action to pack more of a punch, and it didn't. And those who were merely hoping and praying that the Fed action would stabilize risk sentiment, and of course the Fed's move did not. Now, after 2 days of myopically focusing on the Fed, we get to go back to myopically focusing on the Eurozone instead. I put a sphere factor calendar together because there are key events coming up that we need to pay close attention to, drive not only euro direction, but all trading action in all asset classes. And they're lined up here in front of you. I think the big thing is going to be the Germany's ratification of the EFSF. We're all going to be watching that. And then also the whether or not Greece actually gets its bailout funds. I also warned that tomorrow we may be getting some, we're having the World Bank meetings going on in Washington this week, and the G20 has their working dinner tonight, and then we'll have various meetings tomorrow, and there's probably going to be all kinds of sound bites on the, being heard, and the market may be reacting to that as well. This month's Bank of America Merrill Lynch Global Fund Managers Survey put Eurozone peripheral uncertainty as the biggest tail risk for the market right now. Nearly 70% of those polled this month said the Eurozone crisis was hurting market sentiment, which was up from 60% in August and 64% in July. If we could wave a magic wand and make the peripheral turmoil disappear, we might be looking at a much different economic scenario in the U.S. and globally. although the U.S. has its own issues in terms of budget and fiscal reform. Right now, the market is expecting Greece to default on its debt and is increasingly worried about the fallout from default. My colleague Nick Shamim in London put together this data on outstanding Greek debt. As you can see, the main concern will be on total government euro-denominated bonds, which are the lion's share of what Greece owes the world. And generally see three options for the Eurozone with regard to Greece. The first options involve a so-called managed default of Greek outstanding debt. It can be a small managed default where Greece defaults but stays in the EMU, or a large managed default where Greece defaults on its debt but also stays. The third choice is that Greece defaults and leaves the EMU. The first two scenarios may see a knee-jerk reaction lower and then a later rebound depending upon what happens afterwards with peripheral spreads. Greece completely would probably spark a larger negative reaction given likely spillover effects, and typically put a low probability of Greece leaving the EMU and maintain that this would be the worst outcome possible for both Greece and other member countries. Credit Suisse said in one of their recent research notes that they view the breakup possibility as, and I'm quoting, extremely low for legal, political, and economic reasons, end quote. So Eurozone officials are left with doing something that can allow Greece to stay in the EMU and also get their house in order and not be too costly. I spoke to an economist today after the Fed decision and in the wake of the massive deleveraging going on this morning, and he says that the market's preparing for the day after the Greek default. The day after will likely see three things, he told me. First, there will likely be renewed peripheral spread widenings on fears of who might be next. European banks will probably be hit by the same concern. And finally, there will be those who wonder if a Greek default will be the prelude to the country leaving the EMU. For things to calm down, EU leaders will have to convince the market that Greece will be an exception and not the rule, and that other peripheral countries will not follow them out the door. Investors want to know that there will be continued bond intervention by the ECB to keep things stable, and also want to see that all is being done to recapitalize Eurozone banks. If they feel comfortable about this, they will likely feel more comfortable about buying the euro and have less need for dollars. Before we move on to a discussion of euro direction, I wanted to just briefly go over some of the events that will be taking place here in the U.S. that could affect overall direction. We have the next Fed meeting in early November, and then just in time for Thanksgiving, we will hopefully have the super committee's plan to reduce the U.S. deficit. Good news on that front would go a long way to allay fears that political wrangling will weigh on the U.S. economy into next year's election. In my conversations with traders this week, I've been surprised to find so many people talking about an imminent Greek default. Whereas a few months ago, such an event might have caused a 5 or even 10 big-figure decline in the euro, traders are now saying we may only get a 2 or 3 big-figure knee-jerk slide. It much depends on how the default would be structured and the haircuts that are taken. If a miracle, Greece holds in there and the market takes default off the table, the euro could quickly pop back over 140. Right now, I think if we see a decisive close below 135, which seems likely today, the euro may just drift lower in anticipation of the default. I'm not sure that we can get below 130 unless there's further fallout stemming from Greece into the other peripherals, especially Italy and Spain. In the end, we get some good news, and the euro rallies. It will get over its 200-day moving average, which comes in around 140.40 currently, kind of upward momentum. Even after today's slide to 8-month lows near 133.80, we may still be range-bound. We revert back to a 135.140 range or stay in a 133.138 range. We just have to sit and wait for events to unfold. You have to go with your gut on this one, in that conventional wisdom about currency reaction may not hold true under these circumstances. There are still some analysts who say the euro could still see a test of 120 before the euro crisis is resolved. Before we discuss what might happen in dollar-yen, we need to understand why Japan has the problem that it has right now. The market is running scarce, and there are a limited amount of safe haven bonds available to global investors. This slide shows you the size of domestic bond markets globally. You can see the U.S. is the largest and most liquid, with Japan in the number 2 slot. If for some reason you can't buy treasuries or you are heavily long U.S. bonds already, then your next move would be to buy yen and JGBs. And see, other global bond markets just don't offer the depth that these two markets do. So if you can't buy dollars, you naturally buy yen. A one-year daily chart of dollar-yen tells you all you need to know about risk sentiment. When there was hope that the Eurozone peripheral problems would be contained, dollar-yen soared to 85.50. As the year wore on, the peripheral crisis widened, the yen rallied on safe haven demand, and dollar-yen tanked, with it falling to 76.30 on August 1. A few days later, the BOJ intervened to the tune of about $60 billion, with other central banks such as the Fed stepping in with much smaller intervention amounts, and dollar-yen saw a short-lived spike over 80. The gain was short-lived, and by August 19th, dollar-yen had dipped back below 76. And the yen, like the euro, has been largely range-bound. Let's call it a 76-78 range. You could say a dollar-yen move over the 55-day moving average of 77.48 or the 100-day at 78.98 might be promising, but really we would need to head back over the 200-day at 80.70 to know that dollar-yen is probably headed higher. Dollar was last over its 200-day in April, and even then it was only a 2-week event. The pair last traded over its 200-day on a more sustained basis in June of 2010. So until dollar-yen shows signs of rallying, we have to stay focused on the downside. A move below 75 would probably prompt more jawboning by Japanese officials, but would not necessarily lead to BOJ intervention. Large-scale intervention seen in August was prompted more by the magnitude of the move than the break of any key level. What we see initially is the usual quiet bids in dollar-yen from names like Campo. Remember that the MOF decides when to intervene in dollar-yen, and then the BOJ does the intervention. Also wanted to mention we've got half fiscal year coming up for Japan, but remember that Japanese firms have marked their books to market for a long time now, so repatriation flows are not as large as they were in prior years. I don't want to spend much time on the won, but analysts have been pointing out that the PBOC is letting the won strengthen, so I wanted to mention that as a factor. Remember when the global economy was shaky during the subprime mortgage crisis? The PBOC pretty much kept the yen-dollar exchange rate frozen for well over a year. We could argue that China is currently using won gains to combat inflation, but at the same time, if they were overly concerned about growth, they would not be allowing won strength right now. They're penciling in an end-of-year dollar-won rate of about 630 to 633, which would be around a 1% won increase from current levels. There are loads of reports about new China FX bills being put forward in Congress to prod China to let the won strengthen more. Our Capitol Hill reporter, John Shaw, has written a great, John Shaw has said it's been very tough. It would be very tough to get a China FX bill passed right now. And I wanted to mention he has a great piece out today at 1:06 on the main wire on what's going on in the Senate right now. Move on to looking at gold now. Gold's been a tough nut to crack of late. On one hand, it's considered a safe haven, and on the other hand, it's affected by the dollar. And as we've seen today, widespread uncertainty and risk aversion doesn't guarantee a rally in gold. Gold posted a lifetime high of 19.2030 on September 6th. It's been making a series of lower highs, which suggests scope for further losses. However, the bulk of the declines are stemming from paring back of positions and dollar strength. Gold is still viewed as a safe haven, but it's been doing better versus the euro and other currencies than the dollar of late. In August, UBS released a client poll about gold. The poll was taken in the first 2 weeks of August. Some of the responses were ahead of the debt ceiling turmoil and the S&P downgrade of the U.S. AAA rating, and some responses were after. So 6% of those polled looked for gold to be trading over $1,800 by year end, and 32% saw gold trading over $2,000 or higher. At a poll taken at this year's LBMA conference, most of these also looked for gold to trade over $1,000 next year. The bulls polled on the LBMA conference did not look for gold to see the same kind of frenzied run-ups as seen earlier this year. People I've spoken with say with the EMU imploding at the moment, gold will still likely see safe haven demand on larger dips. Say somewhere in the 1700, 1750 area will be good value, and we're trading around there right now. The 55-day moving average comes in around 1731, and we broke that earlier, so now the market's waiting to see gold closes above or below that level. If the dollar keeps rising, and gold falls, there may yet be further fallout to the downside. The 1550, 1575 zone, which contained prior peaks from May and June of 2011, should also attract some gold bottom fishers. I do not see gold positions as especially stretched right now, but given the volatility and lack of liquidity in the market, any larger deal being executed can cause short-term aberration. I'm going to focus on West Texas Intermediate today because that's what I follow most closely. Analysts see the spread of WTI versus Brent remaining wide. The common thinking is that this is all about supply. Here in the U.S. and Canada, there's been higher domestic production in the past year or so, and that's why WTI is, at least when I last looked at it, at 80, while Brent was around 105. I'm speaking with an oil contact Wednesday, and he's been watching the down being seen in the emerging markets this week. He maintained that Brent, which is seen as the world's benchmark, will be harder hit by global growth projections being pared back. This will obviously narrow the spread between WTI and Brent. WTI hit a high of 114.83 May 2nd at the peak of optimism about the world economy. August 9th, and again this was right after the BOJ dollar-yen intervention and all the safe haven buying of dollars and treasuries and the leveraging that was being seen, back then cruised at 75.71. Since then, we've been pretty much in an 80-90 range with mild forays outside of that range. For WTI to really rally, it will need to take out its 55-day moving average which is currently at 90.10, and that comes in right around where the peaks we had from earlier in September. On one side, even if we take out the August 9th low on a similar wave of panic and deleveraging, the similar dips that we saw last month always found underlying demand, and there's no reason to think that global investors won't bottom fish this time also. I would be more confident that either the global economy would improve or that we'd see a larger bout of leveraging like we saw back in 2009. Then you could put on a position with a bigger picture view. The case against larger deleveraging and risk position is twofold. One, there's less speculation and less leverage than back in late 2008 and early 2009. And then secondly, banks and corporations are sitting on much more cash. Each of you have to decide for yourselves when the bottom is in for risk. I will note that the COE's volatility index hit a high of 43.87 earlier, at least that was the high before I came in for the webinar, and that's still lower than the 48 peak we put in August. And then we're back at the peak of the global financial crisis, the VIX hit a high of 89.53. In addition to watching the U.S. and the Eurozone, the markets will be paying close attention to the BRIC economies as well. HSBC's flash September sign of Purchasing Managers Index came out earlier today and showed that the PMI slipped to 49.4 from the final reading of 49.9 in August. And again, that was the flash reading. The flash PMI from the Eurozone came out today too, and that was 48.4 against 49 in August, and that was a bit better than Market News medium of 48.2. Global investors will be paying close attention to the market PMIs to be released in the next 2 weeks. If you haven't been following it already, you might want to also keep an eye on Market News China Business Survey, which is released the final Friday of every month. We released a flash survey the Friday before, so tomorrow at 9:35 Beijing time or 9:35 Eastern time tonight, we will release the flash survey. August survey showed that the overall current business conditions index fell to 55.37 last month, the fifth decline in a row, and at the lowest level since March of 2009. That's the end of the presentation, and I'm happy to take any questions if you have any.
Thank you, Vicki. We did receive one question just a moment ago, and that was, what could prevent a larger slide in the euro?
Well, everyone's pretty much penciling in a move down towards 130. But China is the big wild card right now. Now, every time we've had a euro dip, we've seen a lot of the emerging market central banks coming in, buying euros to get rid of the dollars that they've had from their intervention proceeds. And China's been actively doing that too. But this go around, China might have even more reason to buy euros, even though they might want to, if they think it's moving lower, even they might want to wait for sub-130 levels before they step in. But you have to, there's reason to think that they before, and there's no reason to think that they might not step in now, especially if they're upping their Eurozone debt holding, especially their Eurozone peripheral debt holdings. So I still have a feeling that it's going to be hard to get below 130 than some people are thinking.
And we also have another question wanting your opinion on silver.
Silver, as everyone keeps saying, it's the poor man's gold. And I think silver's really going, and so we always have to consider what the retail investors are going to be doing there. But right now, positions in both gold and silver are not overstretched by any, at least from what the analysts are telling me. And I think in silver, it's going to track gold very closely, and I think it's going to be hard for us to go back up to the highs that we saw back in August. And I think it's just going to really move pretty much in lockstep with gold at the moment.
Great, very much. Thanks, Vicki. Now, if you happen to have another question, you can always email Vicki at vschmelzer@marketnews.com or catch her on Twitter at MNI_FX. And we also have one more question. Any longer-term expectations for Canadian currency with the fall in gold or oil prices?
Well, I think in Canada especially, and I was actually speaking to someone this week about both Aussie and Canada. I think you have to really step back and look at the fundamentals and then pick your levels. We've seen dollar Canada moving back over, it was back over parity back with the dollar, and it was over 103 earlier today. And the thing is, there's a lot of exciting things going on in Canada right now. Now, those exciting things with regard to the oil sands going on, it's still doing very well with there. And sorry, I'm a little bit here because I'm trying to remember what I was told this week. It still has really strong fundamentals. It has people feeling that right now, we're looking at Australia potentially lowering rates, even though Australia also is very dependent on what's going to happen in China. But even with oil prices falling and even with gold falling, still ultimately is going to be viewed as a safe haven. And when we look at, like, the bond market is much smaller, obviously, than ours. If you the chart that we had earlier, Canada, if I'm remembering, Canada was not. I'm going to take a look here. Was not even on that chart. It's a small economy, but there's still going to be foreign demand for a safe haven, and I think that the combination of safe haven demand and the promise of Canada's fundamentals will keep the Canadian dollar from weakening too much. And I think that looking for levels to go short dollar Canada is the right way to play this, to try and sell the rally in dollar Canada.
And then we just received a more general question: do we hold these seminars regularly, or is there a schedule somewhere posted? We do hold these regularly. We try to hold at least one a month, featuring a different reporter in their area of expertise. Next month will be our Bernard Wolfson in he will be about the debt crisis. And we have one scheduled yet, but please check back on mni-news.com. We'll have schedule posted in the right-hand corner, and you can also find a recording to this webinar and other webinars there as well. So,
and I just want to mention on the question on the Canadian currency, I'll email you something out a little bit later. I was all prepared for the euro and yen, and I do have some views and that I can be happy to send on to you.
Okay. And then always we can contact you with questions at vschmelzer@marketnews.com, and you can email me for a copy of today's presentation at lhand@marketnews.com. Thank you very much.